Hello, this is Ezra Trading, and today I'm going to talk how to phases of price. I'm not going to make any series of videos about phases of price. This is going to be a structured video that has all the phases inside it so that you can understand it better. Each of those will have its examples and its key takeaways so that you understand how to use them properly. So let's start with it. So the key concepts of phases of price. Phases of price, we have four. We have retracement, reversal, consolidation, and expansion. Now, phase of price, you don't need to complicate, it's in the name, it's a phase that price has, so we have the retracement, reversal, consolidation, and expansion. Now, price can't and never. So price can always go from an expansion to a retracement, to a reversal, and to a consolidation. But price can never go from a consolidation to a reversal to a retracement. Meaning that price, if in a consolidation, it only can go to an expansion. So let's start with consolidation, which for me, when I started trading, was probably the hardest one to learn. Consolidation, we have two key takeaways how to work with it. So when in a consolidation and we have already our bias established, we want to see two things happen. We want an AMD to happen. So we have accumulation, which is the consolidation. In other words, we have the manipulation, which when marking out the extremes of the range, of the consolidating range, we manipulate one side to distribute to the other. So for instance, if I'm looking for short entries in this trade, I'm looking for the trade to manipulate the high and then distribute lower, just like it does here. But then we have the breakout. The breakout is, for instance, we are looking for longs here. The breakout happens when we do not manipulate any sort of high or low. We just break out of the range, which is kind of in the name. So we have our highs and lows marked out of the consolidation. We see that price isn't reacting to anything. But then we have this breakout. We break out of the range, make a change in the state of delivery, and just close above it strongly, meaning that we didn't manipulate any sort of low, because if we wanted to look for buys and we were looking at an AMD, accumulation, manipulation, and distribution, we will be looking for manipulation to this low, right? But in this case it's a breakout, we don't have this manipulation, we just continue higher. So we see that on this chart on gold, we have this range between the highs and the lows, and it isn't really giving much information to us. It's just going back and forth, and there's nothing to us that it can help us with. Therefore, we see that it's a consolidation. So the highest point and the lowest point are the extremes that we look for on a consolidation, that we expect it to either be manipulated or break out of, right? So for instance, in this case, it's a consolidation, it's also a daily time frame. It's kind of hard for me to expect something in gold because we are on all-time highs, and it's kind of a difficult thing to trade, right? But if I wanted to trade, I would either trade the continuation. This would be either a breakout of this consolidation range or a manipulation to this low and then a continuation higher, right? But on the daily chart, we see that we are consolidating non-stop. Then what happens? After consolidating, not going anywhere, we make one crucial move. We make a manipulation. With this manipulation, this is the crucial part where the AMD happens, right? Accumulation, manipulation, and the distribution is going to happen until we hit sell side liquidity in this case, since we're looking for shorts. I just want you to focus that on consolidations, you need to pick out the extremes of the consolidation. So the highest point of the consolidation and the lowest point of consolidation. And then you need to look for what you want to see. So if I'm looking for shorts, I'm going to either look for a manipulation of the high or just a breakout to the low. But if I'm looking for longs, I'm going to wait for a manipulation of the low for then a continuation higher. Or as a breakout, I'm going to wait just for a breakout to go higher. As we see here, we have the high and the low marked out. We manipulate the high, create a manipulation, then we distribute lower, create a change in state of delivery, retrace back down or back up, and then we distribute lower. Now we've seen a lot of manipulation examples. Now as a breakout is the easiest one of them all that we see. For instance, we want to see long entries. Normally we would want to see this manipulation of the slow, right? A change in the state and then a continuation higher. In this case we do not have that. We have the consolidation, but then we have the breakout without manipulating the slow. So this is a breakout, meaning that with this breakout I'm going to look for entry continuations one way or another to go longer. Is it necessary to have the manipulation? No, it isn't, because we have the breakout. Now you need to align one of them for your bias. If your bias is long, you want to see a breakout of the high. If your bias is short, you want to see a breakout of the low, right? But how do I identify a true breakout? You identify the true breakout by when it's closing strongly above your swing high or swing low, right? We see here that this is a swing high and we displace above it, closing strongly with the body above the high. Same thing is going to be for the lows. Now again, another example of manipulation, which is simply to occur more than the breakout, but when the breakout occurs you're going to see and you're going to know how to work with it. But again, with the manipulation we have the consolidation high, right? One thing I want to mention, fact is that we start consolidating from here, right? But what's the highest point of the consolidation? We start here, but then we create another high, which is higher than this one. So this is the true consolidation swing high. We continue. We go lower, a lot lower, manipulating this low, technically, right? But then we do not displace higher. We don't do much things to the upside, right? Therefore, this is not a true manipulation and distribution setup. This is just another continuation of the consolidation. So swing high, extreme, swing low, extreme. Therefore we want to wait for one of those to be taken out or broken out of. In this case, if I'm looking for shorts, manipulation of the high, continuation lower. Now you've seen and heard a lot of me saying expansion this, continuation that, and I totally understand if you're being confused by it. One thing that you want to keep in mind is that expansion is just a one big sided move, trending move in other words, meaning that if we make some sort of manipulation or just a breakout, expansion is just a one long sided move to the upside or the downside. You see that there's barely any shallow moves to the downside in this example, and this is just an expansion. That's how it is. One thing to make it clear, as an entry during expansion periods, we need to wait for retracements to IPDA array so that we trade the continuation. Take note that the IPDA array that we use to trade the continuation of an expansion is either a fair value gap or an order block. I personally want to wait for a fair value gap to get retraced into. Now I also understand that you don't understand what is a retracement. Don't worry, we'll talk it out in a second. So just keep in mind, expansion is a one strong sided move. Now as examples for expansion, it's kind of harder to explain expansion because it's so easy. And if you don't understand what's really expansion, this means that you just either are really fucking stupid or I don't know, because expansion is clearly just a one-sided strong move to either to the downside or to the upside. There isn't any other thing to explain here. As you see here, this is a classic expansion. We change state delivery and we continue higher. Same thing here. We make a change in state delivery, we expand. Then we retrace into a IPDA array, just like I've said with expansion, how you trade it. We consolidate a bit, changing the state here, and then we expand again. Key concept and key takeaway here is to trade expansion is always after we make a change in the state of delivery. We want to see a form of retracement to a IPDA array, and then we trade the continuation lower. Retracement. With retracements, we want to see the formation of failure swings. So if you understand relevant swings and failure swings, this is going to be the easiest part of trading for you. Because you see, the extremes are the relevant swings, right? After making some kind of move, the retracement we have into some form of IPDA, those are failure swings. And how do you trade? First of all, this is a clear expansion to the downside. So we are seeing right now, we don't want to trade the retracement, we want to trade the expansion. So we want to trade this expansion, continuation to the downside, right? But I cannot enter from here, from the opening of this candle, because the stop loss is too high. Now what I can wait for is a retracement into a IPDA, just like I said with expansion. Then after creating failure swings, with the second change in state of delivery, I can enter with a stop loss much lower and a bigger risk to reward ratio. Retracement is basically the easiest one of them all. As far as you understand failure swings and relevant swings, you're good to go. So this is what I mean by retracement is the easiest one, because retracement is a fundamental for trading expansions. Right after we have this change in the state of delivery, confirming that we're going to the upside, right? How do I trade the continuation of this expansion, right? Because I want to go long. Well, you trade it by waiting for a retracement, a small and shallow move. That's what a retracement is. Small and shallow move to the opposite of the range. So if we're going up, we want to see a small shallow move to the downside, which is the opposite shallow move of the range, right? Therefore, creating the failure swing. And after making a second change in the state of delivery, right? Entry from here, stop loss below on this candle's low, on this failure swing, aiming for long entries to the continuation of the upside. In this example, we see the same thing play out. We see that we make a change in state of delivery, and right after that, we have a IPDA, price retraced into a IPDA. In other words, this is going to be our fair value gap. Then we aim for a continuation to the upside. Now, I want you to have this key takeaway right now about changes in the state of delivery and order blocks. The highest probability changes in the state of delivery and order blocks that you're going to have are the ones that after they swept liquidity, after we sweep some high or low, after sweeping that high or low, we create the change in the state of delivery. That's the highest probability order block or change in state of delivery, meaning that we want to see that order block to be respected. That's the highest probability change in state of delivery that you're going to have. Therefore, I'm very confident in holding this order block, price holding this order block, and after retracing back into the IPDA, we want to see continuation of this price. Reversal. Reversal is when expansion is met with expansion. So reversal is kind of harder to just simulate, because on the higher time frame it can occur most times, on the lower time frame it occurs most of the times. But one key takeaway that you want is that expansion is met with expansion. That's a reversal, but where does that reversal can form from, right? We want a reversal to form from a point of interest. It will be either an old low or old high. Swing high or swing low is the same thing, right? In this case, we have the daily chart as example. We take out the previous day low. After taking out the previous day low, we continue higher, retrace back down, manipulate another low. After this expansion to the downside, we expand back up, expansion met with expansion, continuation higher. Normally, when expansion is met with expansion, you're going to see examples of a V-shaper. So in this example, we see that we manipulate a high, we take out a swing high, we continue distributing lower, we create a change in the state of delivery, right? So now we know that this is a reversal, meaning it's an expansion to the opposite side of the range. So we know how to trade expansions, right? We trade the expansions lower, we want to see retracement into a IPDA array, trading the continuation lower. So here's a 5-minute example. We see that after manipulating this high, we just make these shallow moves to the downside. Nothing here to see. We make a change in the state of delivery, and right after that we see expansion met with expansion. This is our V-shaper, a confirmed reversal. Now you also see that yes, we have an expansion here to the downside and an expansion here to the upside. But this reversal won't play out, first of all, because of the liquidity that we swept. We swept a high and we want to look for sell-side liquidity. And not also that, but we haven't made any change in the state of delivery to the upside. That's why this reversal isn't going to work out in the long term and on the short term too. Therefore, that's how you trade the reversals. Now, as I finish the video, I want you to have all the key takeaways pointed out on paper. Everything that I've said is very important, and everything I've said is not just nothing words. They're very important and are going to be the key takeaways on your trading. So make sure to journal what I said and keep grinding.